Let's start with some really basic principles. And these are real basic. They may even be too basic for you, but it's good to have a good foundational grounding of really how do you make money in stocks? What's the underlying idea behind all this? And stocks are fun to trade and invest and watch them grow over time. I mean, I certainly enjoy that. But in the end, what we really want our stocks to do is make money for us so we can then use that money to fund our goals, fund our dreams, whatever that might be, buying a home, retirement, college education for your kids, whatever it might be. Stocks are a way to make money, and we want to learn how you can make money. And there's two big real ways that you can make money, and that's through growth and through dividends. So let's take a quick look at that. So first off, let's look at growth or capital appreciation, if you've heard that term, capital appreciation. And that's the classic, I buy stock low and then I sell it high, right? Who hasn't heard of that? Buy low, sell high. And that difference between what you paid for and what you sell it for, well, that's your profit. That's how much you've made. And so that's your growth. You want to buy low and sell high. And the interesting thing about stocks is it's a trade, right? If I'm buying a stock, that means somebody's selling a stock. They're trading, right? So I buy and you sell. That means you might not think too great about that stock, or you think there's better stocks, or maybe you're just cashing out to, then spend the money. But I'm thinking I'm going to buy that stock because I have high hopes for that stock. So, and I'm hoping it will grow over time and capital appreciate. So, the stock market is a very interesting thing where you're bringing together buyers and sellers, and both have different points of views on the exact same stock or mutual fund or whatever it might be. Now, of course, the beware around this, of course, is that stocks can go down. Sometimes they can go down and never recover. I mean, when companies go bankrupt, their stock price goes down, down, down. Eventually, it gets delisted and they're bankrupt, and you're out your money, right? Maybe you got a little small claim or maybe a little bit, but most times they go bankrupt. As a stockholder, and we'll learn about this, you're kind of out. So that's the thing, stocks can go down, and they might go down, and you might want to sell them because they're going down, and then somebody else is buying it, hoping that it will rebound and go up, and we're going to learn about all things like that. So capital appreciation, right? Simple, buy low, sell high. The other way you can make money in stocks is through dividends or income. You're basically getting regular income. It's very much a passive income thing. You don't have to do anything. By virtue of owning the stock, typically on a quarterly basis, you get a payout. The company that the stock you own pays you money. Wow, what a great thing, right? So even if my capital never appreciates, maybe even I might lose by the time I sell out on that stock, so I might not have any capital appreciation or growth. But if it's a dividend-paying stock, and not all stocks are dividend payers, but if it's a dividend-paying stock, it's going to pay me quarterly a regular check, basically, of income. And it's kind of a thank you for being a holder of the stock, but the big part of being a stockholder is you're an owner in the company. It's more than just a thank you. It's like, hey, you're an owner, and you're looking to take that money out of the business and then invest it in other things or spend the money on something fun, or a home or a vacation or whatever you might want to spend the money on. So, but it's regular quarterly income. And so that's why a lot of people like dividend stocks, because even if they don't get that growth, they're at least getting some regular income from the dividend coming up. Now, some growth stocks, like a high-end tech stock or high-growth tech stock, might make so much in capital appreciation that overall it does much better than even if you have a great dividend-paying stock. And so that's the trade-off between growth and income, or growth and dividend-paying stocks. One beware around this, key beware around this dividend aspect is that companies don't have to pay a dividend. Now, companies like to pay a dividend. They've been paying it regularly. That's something they really promote, and people will buy that stock because they've been paying a dividend for 30, 40, 100 years in some cases. But at any moment, they could either reduce the amount of that quarterly dividend or the quarterly payout they'll give you, or eliminate it entirely, particularly when times are bad. We saw during the Great Recession of 2008, 2009, lots of companies were struggling, and just to stay afloat, not only were they laying off people and doing other things to reduce their expenses, but they were also reducing the size or eliminating their dividend. When they do that, it makes your dividend price, your actual price, what you paid for the stock, go way down, so you miss out on capital appreciation until it comes back up if you want to be a buy and hold type person, or you're missing out on that income that's coming in. So, there's a downside risk to dividends, but dividends are great to give you that regular income. That's why a lot of financially independent people or retirees like dividend stocks, because they get that regular check coming in that they use to help fund their retirement, basically. And then lastly, there's kind of like the in-between, right? There's like growth stocks or dividend stocks and things that, how you want to meet your goals with both those. But there's also, you might have heard terms like categories like growth and income. Maybe you've seen some mutual funds that promote themselves as a growth and income fund or something of that nature. And isn't that great? You get the best of both worlds, supposedly, all right? You get growth in the stock, they're looking at that, and then you also get some dividend paying too. And ideally, that's what we want, right? We want to invest maybe, let's say, in dividend stocks, but we want some growth as well if you want that combination platter. The challenge with that is sometimes companies that are really great on the growth end and they don't pay any dividend, well, that might be a better performing stock than a growth and income type of stock. Or stocks that are really, really good at paying a high dividend might not have that high in growth, but they pay a good dividend and it's a solid regular payer versus maybe something that's more in the growth and income kind of that combo category. So that's a basic overview. This is the pretty simple stuff, and then we're going to build from that. And when we start thinking about selecting stocks and looking at ratios and looking at things like, when you look at things like, can they continue to pay out the dividend? Things like a payout ratio is very, very important. But in a nutshell, as you go through everything in the course, understanding the different aspects of stocks and investing in stocks, underlying all of it is these two very big concepts of, is my stock going to grow up? Is my stock going to grow? Maybe it'll grow up too. Is my stock going to grow? And maybe it's mature. That's the growing up, right? So is it going to grow and I make money on that capital appreciation, or will it pay a dividend? And if you look at a life cycle of many stocks, they start as, maybe small companies, they don't pay a dividend, they have this high growth, and then when they get to a certain size, maybe then they've slowed down their growth and now they want to start giving back money in terms of shareholders, to shareholders in the terms of like dividends. A good example like that would be Microsoft, for example, high-tech company, right? So for the longest time, they invested all their money back in their company and had a lot of cash on hand, and they just grew, and they want to be like any other tech stock that wants to really grow, but they started reaching some maturation points. They had such cash on hand that they just really didn't know what to do with, so they started paying that out in dividends and rewarding those owners. So it went from a small startup from many decades ago to a high growth company, to a mature company, to a more mature company that's still growing, but also is rewarding shareholders with a dividend stock. So if you've held Microsoft, for example, since the beginning, well, you've been very well rewarded. But either way, you're looking at growth and income or growth and dividend as a way to make money in stocks.